Ladies and gentlemen, good evening and welcome to Medi Healthcare Services Limited's Q4 and FY2024 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Neeraj Didwania, Senior Vice President, Strategy at Medi. Thank you, and over to you, sir.
Thank you. Good evening and a very warm welcome to each one of you to Medi Healthcare Services Limited's earnings conference call as we share Q4 and financial year 2024 financial results with you. The results of the company, the press release and the investor presentation have been uploaded to the exchanges, to our website and also distributed through our mailing list. Please note that any forward-looking statements are to be relied upon based on your own judgment, and all financials and operating numbers discussed on the call are audited and or management estimates, and hence investors should refer only to the uploaded financial statements of the company. Without further ado, I would now like to hand over the call to Dr. Vikram Chhatwal, Chairman and Whole-Time Director of Medi Healthcare Services Limited.
Thank you, Neeraj, and a warm welcome to all Medi shareholders and other participants joining from India and other parts of the world. My name is Dr. Vikram Chhatwal, and I am the Chairman of Medi. With me on this call today, I have Mr. Satish Choudhury, our CEO, Mr. Matthew George, our CFO, and Neeraj, who you have already heard speak, who heads our investor relations. As I present the financial results for the quarter and full year ended March 31st, 2024 today, I do want to take you back into a few lines on the health insurance sector in India, which has and will continue to grow, supported by tailwinds including the regulatory commitment to enable insurance for all by 2047. This push by the government and private enterprise will continue to have tremendous positive impacts on the insurance industry and the PPE industry that we are a part of. As a company, given these tailwinds, we continue to create newer value pools in the industry while we maximize our participation in the existing ones. Notably, the recent news about the composite license for life insurers and a possible downward revision in the applicable GST on health policies, if implemented, will be a win-win for all stakeholders and, most importantly, the policyholder. As you all know, the health insurance segment for the general insurance industry continues to be the largest segment. Of course, we continue to see that the group health business leads the pack. I now take you through the highlights of our company's performance. The total premiums under management that we administered as a company was at 19,050 crores as on 31st of March 2024, a growth of 30.7% over the corresponding period of the previous year. Further, if I break this down into its respective segments of group and retail, the group segment sum was 16,709 crores, a growth of 30.4% on a year-on-year basis. The retail segment was 2,341 crores, which is a growth of 33.2%, on a year-on-year basis. As a share of total industry health insurance premiums that we administered, this takes into account both group and retail policyholders. Our share was at 19.6%, delivering our share growth of the total health insurance industry premium by 186 basis points over the corresponding period of the previous year. This again, if you looked at the 19.6%, which is our share of the total health industry insurance premiums, and we break that into group and retail, group accounted for 30.4%, which was a 299 basis points growth on a year-on-year basis, and the retail segment market share was at 5.5%, which is a growth of 50 basis points on a year-on-year basis. As I now hand over our call to our CEO, Satish Gidugu, to walk you through the specifics of the company's performance. Over to you, Satish.
Thank you, Dr. Vikram, and a warm welcome to all Medi Assist shareholders and other participants, and thank you again for joining this call. Medi Assist has delivered another year of strong growth with a 3-year revenue CAGR of over 25%. And this is backed by the trust we continue to enjoy from our customers. Our organic growth and also with successful integration of acquisitions stand testament to our performance. While we will discuss the financials a little later on this call, a couple of highlights that I want to bring to your notice. We've maintained retention of group accounts at 94.7% for Medi Assist, marginally higher than the previous year's numbers. And we also, as we see the health insurance plans bring in outpatient benefits significantly, we processed 3.6 million outpatient claims last year and brought in significant cashless utilization even into the outpatient claims that we process. And with respect to technology, Medi Assist emerged as a leader for the National Health Claims Exchange integration and successfully completed all use cases for multiple insurance companies. We also won Best Use of AI in Healthcare award for proprietary fraud detection engine, and we continue to invest in preventing fraud, waste, and abuse and delivering savings back to the ecosystem. And we're also building a capable and in-house team of data scientists towards better data security, analytics, and use cases for all of our stakeholders. I'd now like to hand over the call to Matthew George, our CFO.
Thank you, Satish, and a warm welcome to all the participants. We have had a fantastic quarter and an awesome year. So I'll take you through the financial highlights for the quarter ended 31st March of 2024. Our total income was 171.1 crores, a growth of 22.9% over the corresponding quarter of the previous year. Revenue from contracts with customers, this is excluding other income, or what we call as operating income, is 166.8 crores, a growth of 22.6% over the corresponding quarter of the previous year. Revenue from contracts with customers included 11.4% from our government business and 5.2% from our international benefits business, which is Medicare retail. EBITDA, excluding other income, operating EBITDA, is INR 37 crores for the quarter, a growth of 20.7% year-on-year over the corresponding quarter of the previous year, a margin of 22.2% on operating revenue. Profit after tax is 25.7 crores at 15% margin on total income, a growth of 50.6% year-on-year over the corresponding quarter of the previous year, a margin improvement of 277 bps year-on-year. Now I will take you through the full year numbers for the year ended March 2024. The total income is 653.1 crore, a growth of 25.8% over the previous year. Revenue from contracts with customers, excluding other income, which is operating income, is 634.7 crores, a growth of 25.7% over the previous year. Revenue from contracts with customers included 10.1% from the government business and 5.8% from the international benefits business, which we call Mayfair Retail. EBITDA, excluding other income, operating EBITDA, is 133.3 crores, a growth of 11.7% over the previous year, a margin of 21% on the operating revenue. Profit for the period, adjusting for the exceptional item of 21 crores, is 92.3 crores, a growth of 22.6% year-on-year over the previous year, a margin of 14.1% on total income. I will now give you a few highlights of the balance sheet and key operating metrics for FY24 are as follows. The net cash balance on our books is about 245 crores. This is what we compare to 255 crores of the previous year, post all the acquisitions of 135 crores which we did through the year. So we have accrued cash back on the balance sheet. Our net worth is 481 crores. Our return on net worth is about 19.2%. Return on capital employed is about 20.4%. Revenue per average headcount on non-government contracts is 1.38 million. We continue to be debt-free and continue to have a very strong balance sheet. Thank you all. I will now hand over the call to Neeraj, who will take us from there.
Thanks, Dr. Vikram, Satish, and Matthew. We can now open the call for questions from the participants. If you have any questions, please direct them to Dr. Chhatwal, who in turn will ask the concerned team member to respond.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Chintan Sheth from Girik Capital. Please go ahead. Mr. Sheth, your line is unmuted. You can proceed with your question. As there is no response from the line of current participant, we'll move on to our next question. The next question is from the line of Gautam Gosar from Monarch AIF. Please go ahead.
Hi, sir. Thank you for the opportunity and congratulations on good set of numbers. My first question is, what would be the revenue split for the retail group and government business for the quarter and the year?
Thank you, Gautam. I ask Satish to answer this. Over to you, Satish.
Thank you, Gautam. As we've provided the premium splits of group and retail. From a revenue and operations perspective, we see it as one large revenue pool. So I think we have the premium splits that are already in the presentation.
Okay, let me ask it another way. What would be our take rate for the retail and group business? And we've seen that the take rate has been declining. So if you could highlight the reason for that and what can be the sustainable take rate which we should look at?
So I think like we've mentioned multiple, even in the previous calls, our take rates are subject to a combination of insurer and the product. And depending on the kind of workload that we have as per the product. We've also historically mentioned that in the group products, take rates vary anywhere from 2.5% to 4.5%, depending on the product and the policy. And in retail, and especially when the benefit policies, again, we see anywhere from 2.5%-3% all the way up to 5.5%. So the take rate that you see is a mix of two things, right? Which is the mix of the business between group, retail, and the products. And secondly, for all of the business that we win, depending on the timing of when we win the business, there's a significant portion of the revenue that we also defer out into the next financial year. For example, we net deferrals from last year to FY25 is 220 crores. So that also sort of could potentially artificially show a decline in the take rates. But otherwise, I think we see no concerns on the take rates from a quality of revenue perspective.
So what we understand here is that our base take rate would be 2.5% for both the businesses, not below that, right?
Yeah, but not usually. That's reasonable. 2.5 to 4.5 or 5.5 is the range that we operate in right now.
Okay, and we can take this as a sustainable take rate going forward as well, or do we see any decline here?
It's hard to comment on the future, but traditionally the base plans, which is the core benefit plans, either in retail or core benefit plans that employees, spouse and child, that typically are offered by the groups, are fairly stable. The add-on plans, of course, come at a lower take rates, especially as the group customers continue to expand benefits and allow employees to opt in for host of benefit plans, which typically may not be at the fully priced premiums and fully priced take rates, but otherwise we see stability in the base plan rates.
Okay, sure. And lastly, I have a question on the industry perspective. So how is the share of premium service by the TPA shaping up on an industry level? I think this number was around 55% last year. So how do we see this in the next 3 to 5 years? What's your comment on this?
Okay, Neeraj.
Yeah, hi Gautam. So we published data till 2022, where the share of the TPA industry out of the total health insurance premiums was about 55%. And there was a 3 or 4 year trend of increasing from a lower number to the 55%. We currently don't have the FY23 data because not all TPAs had reported. Some TPAs had discontinued their operations. Some licenses were not renewed. So the latest data that we have is only 2022, which is published data, and that is what we can talk about. If there is any updates that we are able to get, which we can disclose to the public, we will keep that in mind and share that with the public.
Sure. Thank you so much.
Thank you.
Thank you. The next question is from the line of Prakash Kapadia from Spark PMS. Please go ahead.
Yeah, thanks for the opportunity. A couple of questions from my end. In FY24, if you could help me understand the impact of, acquisitions on the incremental depreciation and amortization. There is an increment of 17 crores and, any other legal, M&A or, other costs which are up 6-7 crores. I'm just trying to, look at the numbers, X of these numbers.
Yeah, I'll hand it over to Matthew to respond to you. Thanks, Prakash.
The impact of acquisition on depreciation and amortization is about 18 crore. 10 crore of that came on account of customer relationship that we created as an intangible. 10 crore is on account of that, and 8 crore is on account of the assets that came out from that acquisition. So total is 18 crore.
So the entire this thing could be attributed to the M&A transaction.
Yeah, it's correct.
Largely, yes.
Okay. And any one-off expenses in the other expenditure or the legal or some of these costs, or that is the normal increase which we've seen on a year-on-year basis?
Matthew will answer that again.
Yeah, if you look at our legal and professional, there is you see a large number out there, and that's primarily due to the acquisitions. On an ongoing basis, the legal and professional is not going to be at that. There's no run rate for legal and professional. It will be a much lower amount. And I think there was a one-time catch-up on the printing and stationery also because we acquired these businesses and we have to catch up on that. So that there's some recent people who have worked there, but other than that, no, there's not significant one time of the system.
Okay. So it could be 3 to 4 crores. Is that a fair assessment if I were to quantify it?
It should be about 7-8 crores, including the pending, legal and professional.
Okay. Okay. And secondly, we've obviously had, unbilled revenues. So could you help me understand, the impact of these unbilled revenues to the next year growth based on our history? Is there a specific contribution which typically comes, obviously, to our total revenues on a going forward basis? Is there some correlation which, you can quantify or help us understand? That would be helpful.
So I think you're referring to 2 points here. One is on the unbilled, which actually will get billed out in the current year. But to your point, the correlation of the next year revenue comes in from our contract liabilities, which is our prepaid revenue, and that number is about 220 crores. So if you take the next year, whatever the revenue is, 220 crores of that is already on, that is loan to the next year for us. Automatically, it's prepaid the income that is booked.
So on this additional base, the growth will be determined by the kind of premiums we are able to service. This obviously will get accounted 1/365 as we execute.
That is correct.
Is that the right understanding?
That's correct. We execute 1/365 what we do, and we recognize it for the period of service.
So if I could just nuance it, a significant part of our growth comes from retention. Retention continues to be our focus on North Star metric. For example, in the group, these are annual policies that renew. So in group, we have 94.7% retention. So every policy, when it renews, even on the renewal, the revenue is booked on 1/365, plus all of the new policies that we onboard, either on group and retail, they also go into the 1/365. And the timing difference of that vis-a-vis the financial year results in the contract liability or the deferred revenue going into the next financial year.
Right. So it's a combination of renewals, new policy additions, but given the base and our leadership, renewals would be equally important, is what we are alluding to, right?
Right.
Fine. Understood. That is helpful. Thank you.
Thank you.
Thank you. The next question is from the line of Chintan Sheth from Girik Capital. Please go ahead. Mr. Sheth, your line is unmuted. Please proceed with your question. As no response from the line of the current participant, we'll move on to the next question. The next question is from the line of Senthil Kumar from Joint Rate Capital Services Limited. Please go ahead.
Good evening, sir. Am I audible?
Yes, sir, you're audible.
Yeah, thank you. Thanks for the opportunity. Congrats for the market share gain. I have 2 questions. My first question on margin. I could find that now margin excluding other income is 21% against of 23.63 last year. So what are the triggers the management foresees to reach back this EBITDA margin to 23% in upcoming years, sir? Key triggers.
Satish. Senthil, could you mute your line, please? There's lots of background noise.
Yeah. Thank you, Senthil. As we've discussed before, for the past 2 years, we have been consistently at 23 to 24% margin as a company. As you're aware, we've acquired and integrated 3 companies in the last 12 to 15 months, including Mayfair, BKF, which is a UK-based company, and Advantage TPA in India, and Raksha TPA in the month of August last year. So these integrations will typically take us about 4 quarters to normalize into our operating processes and the margin profiles on an average. In fact, if you look at our history, we were about 20.5% margin, and end of 9 months despite the Raksha coming in for the first time, we held on to our margins. And then we have marginally improved our overall EBITDA margin for all of FY24 by the end of March as all of the synergies, continue to kick in. So we expect to finish integrations as planned and, get back on track at the earliest. So that's where we are on the margins.
2025, end of FY25.
I wouldn't necessarily comment on the specific number, but like I said, last 2 years, consistently we were at around between 23 to 24, and we are back to 21 with some of the synergies from the acquisitions already kicking in.
Yeah, I understand. The quarterly basis, we are at 22.2%.
Yeah, the last quarter was 22.2% on a standalone basis. Thank you.
Yeah, I understand that. And secondly, so what is the debtors basis for FY24, sir?
Debtors? Is that the question on debtors?
Yeah, debtors days. Because I could find that it is more than 100 days. Confirm you.
Yeah, right. So let me just explain the debtors. We have a very stringent debtors policy. Okay? And when we talk about debtors, first let me apprise you about DSOs. When we came to the 6-month number, we were up to 135 days is the DSO. In the 9 months, we were down to 105. Currently, we are down to 102. That's our DSO for the company. And we should be around 90 days. So there's a 12 days inefficiency in the debtors when you look at it. But as a aging policy is concerned, as far as aging is concerned, we don't have any debtor greater than 365 days, which is not provided for. And we don't have any debtor any debtor greater than 6 months is either provided for at a rate of 25%, and we don't have any disputed debtors on our balance sheet. So our bill receivable, our collectability should be in the range of 34 days today. So we don't have significant aging on our balance sheet, and we continue to keep it clean. And this is because of our unbilled revenue policy. What we do on the unbilled is any unbilled greater than 6 months, we reverse it. So we don't even bill if it is not billable and collectible. So that's what we do, and we continue to keep our debtors clean.
Very clear, understood. And lastly, can you just confirm what is the yield for this quarter, sir?
Sorry, what is the yield?
Yeah, yield for this fourth quarter, Q4.
Q4 yield is the question? Sorry, you're not very clear.
Actually,
Yeah. So we've always maintained that yields are actually derived for us. So we don't actually publish any formal yield numbers, because even if you look at Q4, the premiums we've added, we may not have serviced the full premium for the entire period of Q4. We always report premiums as on date, so that's why the yield calculation is always could potentially be misleading. I think Satish had already answered the range that we have as a take rate for group and retail segment. So broadly, it's always in that range at the portfolio level.
Okay, so very clear. Thank you. That's it from my side. Thank you. All the best.
Thank you.
Thank you. The next question is from the line of Aman Singh from Nuvama. Please go ahead.
Hi, am I audible?
Yes, you are, Aman.
Hi, thank you for taking my question. 2 questions. Firstly, on dividend. So the company has declared around 40% dividend payout this time round, which is higher than the previous years. So do we have a stated dividend policy, and do we declare this kind of dividend going ahead?
Yes, we have a stated dividend policy. On the maximum side, we can go up to 75% of the current year's profits and 25% of the previous year's reserves. In the past 3 years, if you see, we've disclosed that dividends have been in the range of 15% to 30% of the current year's PAT. So this year also it's been broadly in that range, 30% plus. So we will evaluate every year based on how the year has been and what our plans are for the future, and then announce the dividend. So we don't have a fixed number that we can give. Yeah, so the dividend should be looked at on a profit after tax, excluding exceptional item, which is 92.3 crores, which Matthew had announced. So that is the real profit of the company. The exceptional item is really a tax neutral pass-through. So on that, it's roughly around 30%.
And the second data keeping question, can you give me the ESOP impact for the year, and how do we see the ESOP cost for next FY25-26 and going forward?
Yeah, so the ESOP cost impact on the P&L is about 3.5 to 4 crores, and that's been in the range. Year on year, we've seen that as a stable range, so you can take that as a number.
Okay, thanks.
Thank you. The next question is from the line of Silky Jain from Canara Robeco. Please go ahead.
Am I audible?
Yes, ma'am, you're audible.
Yeah. Hi, sir. So just wanted to understand a little bit more in terms of the premiums and the revenue conversion. So if we see the growth in premiums has been around 30-31% for this particular year, whereas that conversion is slightly on the lower side. And if we see similar run rate in the last few years also, this number is actually declining. So how should we look at this particular number going forward? Like, is it if the premiums grow at a certain rate, that the revenue growth would be lower? That is understandable, but can we try to interpret like what would be the proportion going forward? Like, is this number only going to the gap only going to widen from here on?
Hi, Silky. Thanks for the question. So, as we have communicated in the past, the translation from the premium to the revenue, there are 2-3 factors. Number one is what is the period in which we book the premium, and so what kind of revenue gets reported out of that premium for the current year. The balance moves to the following period as a deferred revenue, so that changes on when we book the premiums. The second is for this particular year and also for the last 1 or 2 years, it's not steady state because we've had acquisitions in each of these years. So even for the current year, the premiums that we are reporting is, let's say for Raksha, is on a full year basis, but the revenue translation of that premium is not on a full year. It was consolidated only for 7 months. So that also has an impact. And the third is the premium growth when you say, and you mentioned 30%, there's also a mixed impact on the premium. The premiums grow because of multiple factors. Some of those factors will have a like-to-like revenue conversion. Some of them may have a differential revenue conversion. So it's actually a problem that we also face. That's why we always feel that on an annualized steady-state basis, you will see a trend, but last 1 or 2 years are not comparable because of the acquisition. This becomes very complicated quarterly, so very difficult to give a guidance on that.
Okay, get it, sir. But can we get a breakup, like in terms of what was the revenue contribution from Raksha and what was the premium contribution? So that excluding that, we can look at it, and that could be the steady state assumption which we can take going forward as well.
So actually, for the acquisitions, we are not giving any revenue breakup because the acquisitions, the nature of the business is such that we have to hold on to the business and renew these accounts after we acquire them also. So it's equivalent to like an organic growth for us. So you should look at the company as a total premiums administered and then as a total revenue that we generated out of that, plus the revenue that has moved on to the next period, which is pretty much like guaranteed revenue that we have in the bank.
Got it, sir. And so if we look at it in terms of employee base, so can we get the total employees as on FY24 and also, if possible, to get like how much employees were added by the acquisition?
Yeah, so the total employee base is about 6,400. We've disclosed this in the investor presentation. Sorry, 6,140. Last year was 5,470. Raksha ballpark added about 750 to 800 employees. But we can get back to you with the actual number. I can't give you the exact number on the call. But we are closing the year with 6140 headcount. It's on slide 12 of the investor presentation.
Got it, sir. So incrementally, like at least in this year, we have not booked the revenues from Raksha, or it has only been booked for 7 months. but the cost has been entirely apportioned, right, in this year? What
Yeah,
is the
so Raksha was lower margin than our business substantially. So the cost, of course, has hit us right from the first month. And for full 7 months, the cost structure is different to what Media's cost structure was.
And typically,
Ms. Jain, may we request you return to the question queue for any follow-up questions?
just a continuation of this. Sorry, I'll get back after that. Is it in terms of break-even, how long does it take for an acquisition to break even in terms of margin?
So we just answered this on the call itself, that it generally takes about 3 to 4 quarters to bring the acquisitions to our margin. So Raksha, we've now seen about 2 quarters, and maybe in the current financial year is when we expect to. You said break even, or are you asking for our margins?
Break even.
No, break even. Matthew,
Raksha as a standalone entity continues to be profitable.
Okay.
What we are talking about is bringing that margin profile to our margin profile. We're talking about a 21% or a 22% company and acquiring a 10% or a 12% company and then bringing it to our margin profile. That will take 3 to 4 quarters. But on a standalone basis, they are profitable. They continue to be profitable. And we have not had any significant customer acquisition or any cost for concern. So we do expect that in the next 2 to 3 quarters, we should have them back on track and then back into our markets.
Okay. Thank you so much.
Thank you. The next question is from the line of Sahej Mittal from 3P Investment Managers. Please go ahead.
Am I audible?
Yes, Sahej, you are.
Hi, thanks for the opportunity. So just this one question on the margins. So, given that, firstly, I mean, what is your normalized or targeted EBITDA margins for Medi as a TPA business on a console basis? The EBITDA margins where we have reached 21% for FY2024.
So for the last 3 years, we've been in the 22 to 23% EBITDA margin range. Now, the biggest challenge for us is to project what kind of claims volume we end up supporting, because that's really our biggest cost driver. And also the accounting challenge we have is what part of the revenues actually get booked in the books of accounts based on the premium getting booked. So it's very difficult to tell you that this is the stable margin, and especially after these acquisitions. But we've been in the 23%, 24% range for the last 2 years. And like Matthew had said, we've exited Q4 with a 22% margin and a 21% for FY24 margin. So you will have to project on that basis.
These unbilled revenues come into our base as well, right? In Q1 as well. So on a full year basis, it does not matter. So which is why I'm trying to understand. I mean, given that we did this acquisition, we would have like some targeted margins, right? Even when we are sort of running the business, that was only a point. And so I was trying to understand from where will this margin improvement come from? Will it be from the staff cost line item that the staff cost sort of remains at these levels and the top line continues to grow, or will it come from laying off or optimizing the number of employees which we have in our base? Yes.
Yes, there's actually, you almost answered the question. So it's like all of what you said. We've always enjoyed a 23-24% margin historically, and most of the TPA industry operates in a high single-digit margin profile today. The predominant difference in our books actually comes from the significant use of technology and automation in the way we deliver. And of course, part of it is scale, but most importantly, the significantly high retention number in an annual contract business,
at up close to 95%, which also creates that predictability of revenue and our ability to sort of scale our operations without sort of looking at from a policy to policy perspective. So when we acquire companies, obviously the target is to flip the operations into our operating model, move the claims in the back office to our technology platforms, and those automatically sort of result in productivity and account efficiency. And which is why we sort of consistently maintain that about 3 to 4 quarters is what it takes us. And the target is simply to sort of flip them into our operating model and then see it as adding all of that revenue incrementally to our revenue. Of course, we also have to work hard to make sure that all the contracts we continue to maintain, because that's the nature of the business.
We also have some levers in others which we already planned for at the time of acquisition, and those are under execution, and some of them have started showing results. So I think that we will continue to benefit from those synergies that we had forecasted for when we went out and made the acquisition.
Got it. Can I slip in one last question? So, is it fair to assume that our staff cost on an absolute basis would sort of remain at similar levels into FY25? Is it a fair understanding? I'm just trying to get some sense.
I think we've been very consistently around the 40-41% mark as a percentage of revenue. Despite almost 3 years now, despite our volumes and the business more than doubling. So we believe that our technology will continue to evolve at that pace that will handle those volumes.
Got you. And on the depreciation front, obviously even a 1 crore or 2 crore increase gives us a 5 to 10% kicker on our PAT, right, on a quarterly basis. So from here on, will this depreciation, I mean, given that ours is not that heavy, asset model, so would the depreciation sort of go down from current levels?
No, so this is if you see the March quarter, because all the acquisitions and everything is now for the full period, the March quarter should be the base. We don't anticipate it to go up, but I don't think it will go down because everything tangible, intangible, all assets are fully priced in the March quarter. So there's a very nominal jump from December to March. If you see previously, December there was a decent jump, but from December to March there was a very nominal jump, and this should be the new base is what we believe.
There will be a slight reduction in depreciation, but that will get offset by the reduction in intangibles. So it may not be significant, you can forecast maybe a 5-10% reduction.
Perfect. And any reason for the reduction, I mean, drop in tax rate in 4Q?
So tax rate, this is the last question side because we have a queue. So
our ETR, as you can see, is about 16%, and that's our normal tax rate should be forecasted in the range of 22%. This year we had a benefit of 4.8 crores, which is there are 2 factors that contributed to it. One is the dividend from a domestic company and the APM, for which we got the benefit this year. And then we did a putting, so we cleaned up a tax saving in one of our subsidiary companies, and that resulted in a tax saving of about 3 crores. So if you take out the 4.8 crore from the face of the P&L and from the tax item, you will see that it is 20%. So you should forecast for a 21% to 20% on an average.
Thanks for answering all the questions, and all the best.
Thank you.
Thank you.
Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please restrict your questions to 1 per participant. If you have a follow-up question, you may rejoin the queue. The next question is from the line of Sarang Sanil from RW Investment Advisors. Please go ahead.
Hi, good evening, sir. Thank you for the opportunity. My first question is, I believe that Raksha's integration would go on for another 1 to 2 quarters, right? So what is the quantum of expense that will eventually fade away post integration? And what is our aspiration on the margin side? I understand you would want to go back to pre-acquisition margins, right? But in the past, you've gone as high as even 25.5%. So is there a target for FY25 and possibly for FY26 on the margin front?
So I think we will restrict ourselves to the periods that we have presented in the prospectus, which is the comparable business. For the 3 years, we were consistently at 23 to 24%. Of course, like you rightly said, and we repeated multiple times, and our target when we acquire a company is to get them into our operating model and ensure that the consolidated business goes back to our margin. And you are right, I think we have 2 more quarters of Raksha in the next year. But with Raksha already in, we are at about a 22% in Q4 as an EBITDA run rate. So I think the synergies are already kicking in.
Sure. Okay. So could you please provide with the unbilled receivables for this year? I believe it was about 120 crores for H1. So
Unbilled
receivables.
Sorry, could you repeat the question?
Yes. So unbilled receivables for the year. I believe it was about 82 crores last year, 120 odd crores this first half. And what would that number be for FY24, the entire year?
The unbilled receivable is 117 crores. And when you look at our unbilled, you should also know that this is the nature of the industry.
Yes.
We do get our premium policies renewed on day one, and the insurance company takes anywhere between 30 to 60 days and 90 days in the case of private companies to give us the premium rates that are billed. So out of this 117 crores, we have billed out about 25% of that in the period that is completed from April to now, and we do expect to bill out everything in the 60 to 90 days. And as a policy, you should always remember that we don't carry any unbilled greater than 6 months. So if there's any unbilled greater than 6 months, we reverse it, and we only recognize the revenue when we have the right to bill. So I can say with absolute clarity that there's no risk on the unbilled, and we're very conservative on recognizing unbilled. Unless we have a policy and confirmation that it has been renewed, and based on the estimated amount we take an unbilled. And we have always been very conservative on that and never had a reversal ever in the past 2 years.
Got it, sir. So my last question would be any positives on the yields that you're hearing from the insurance companies or repricing that's benefiting us?
Can you repeat the question?
Yes. So any positives that you're hearing from the insurance companies while we have any repricing with the insurance companies? Or is it none? Okay.
None.
Sure. Okay. Thank you so much, sir, and all the best.
Thank you.
Thank you. The next question is from the line of Aditya Sharma from Aditya Birla AMC. Please go ahead.
Hi, sir. Thanks for the opportunity. I just wanted to understand the organic growth, the revenue growth that we have delivered in this quarter. If you take out the acquisition part, what would that be?
I think if I look at from a full year perspective, Aditya, about 14% would be the same store growth, and 12% is from the acquisitions of the total 26.
Right. Got it. And also,
if I could just request that when you read the 14 and 12, the 12 are all pretty much same store growth templates because the acquisitions were done in a period, and thereafter the renewal retention rate that we present to you at close to 95% forms the base of the total business. So the acquisitions only contribute to a one-time add, but thereafter the 14 and 12 merge into one singular growth story of renewals. So I would request that those listening to us, please keep in mind that these are annual policies that renew, and that it is incorrect in our minds to look at same store or organic growth versus acquisitions as 2 different targets. They merge on the day of the acquisition into one target on a 12-month renewal cycle. Over to you.
Sir, can you please, I'm really sorry, if you could explain this, probably I didn't catch it.
Maybe, Aditya, I will ask Neeraj to take this offline and explain the nature of our business to you separately. Thank you.
Sure. Also, wanted to understand, we are sitting on decent amount of cash. We do not require too much of CapEx. Do we see any more acquisitions? Are there any deals that you're currently evaluating, or is it just that?
Aditya, no forward-looking. Aditya, I have no forward-looking statements to make. We will continue to evaluate, but have no plans at this point in time.
No plans. Okay. Last question from my end. I just wanted to understand why have we been kind of a laggard in terms of market share in the retail segment? If you could help us understand why we are dominating clearly in the group segment, but and how are we trying to tackle that?
Thank you for that. Obviously we have our core DNA originally was group, and group is what led the growth of the health insurance industry for a significant number of years now, growing faster than retail. So we were able to capitalize on that. Of course, retail is a focus. Now we work with 14 insurance companies on the retail portfolio as well. And one of the reasons you don't see retail market share is because in many of the retail products, we don't necessarily work on a premium and the PPA fee basis. We provide multiple other services. We do not report the premiums to the extent that it's sort of standard PPA service for now. But our retail segment has actually grown at 33% year on year, and it continues to be a focus area for us to both expand insurer relationships and also to improve on the amount of work that we do.
Okay, thank you so much.
Thank you. The next question is from the line of Naman Bansali from Perpetuity Ventures LLP. Please go ahead.
Hi, sir. Thank you for the opportunity. First question is on the cost side. So on the two DRHP data that we have, that is from 2021 and 2023, there are two cost items that stand out. Firstly, which are the advertisement cost, which used to be negligible historically, has been around 19 crores in FY23. And second is the subcontracting cost, which has almost doubled over last 2 years from 30 odd crores run rate to almost 60 crores. So can you talk a bit on this two cost line items, that what has led to such increase? And I think this has led to some sort of margin compression for our business. So can you talk on this?
So the advertising promotion is a expense that we have at the parent level because it's towards the relationship we maintain at multiple segments of our business. So this is not a new thing. For years we have had relationships where we do engage. It's an engagement model with multiple segments that we have. So it's an area that we keep investing into, and that also then contributes to the retention rate, the realizations that we have. So it's in line with the percentage of revenue that we have. There's a range that it gets maintained in, and so it's not the reason for any margin dilution in the last 1 or 2 years.
Right. And for subcontracting charges?
So subcontracting is a combination of some government employees who are government teams who are not on full-time basis with us. We do hire people who are not on full-time. And the second is support services. There are some support services which are on contracted basis. So that is how you should look at subcontracting.
I think for all of you listening into the call, it's important to understand that for non-core capabilities, we have taken the path of using third-party manpower, subcontracting services to enhance and support what is core to us as a TPA business. This is an intentional view that the organization has taken in terms of making sure that any contract that is project-based or timeline-based sticks to a subcontracting template.
Got it. Thank you. And second question is on the AUM side. So in the last concall, you had reiterated that there are various different yields for various different products of yours, which ranges around 2 to almost 5%. So could you just give a picture over last 5 years or so, is that what are the top products which have changed, and What are the top products which have moved, which might have impacted the take rate, or how has that moved?
So it's not products alone. So it could also be the way the premiums have grown. So the premium growth is a combination of new lives, new members, the inflation, which is the price increase by the insurer, and the expansion of benefits. So these are the three key factors that is contributing to the premium growth. The product level changes are at the back end of all of these three. It could be expansion of benefits categories of the product, or it could be pricing related changes, or it could be new member getting added for a specific product category.
Okay. And lastly, out of the 19,000 crores premium which we reported, how much would be the combination of Raksha and Medi Advantage out of that?
It's similar to what Satish said on the revenue side. Largely, the entire premium growth is the Medi Assist base growing at a high rate. And then there is some addition to that on Advantage and Raksha. But again, like Dr. said, retaining that premium is completely our responsibility from the day the acquisition happens, because renewals are happening the same day and following that. So really, it's the same business.
Okay, that's it from me. Thank you.
Thank you. The next question is from the line of Nidesh from Investec. Please go ahead.
Thanks for the opportunity. The first question is on the group business. How are the trends on the renewal, premium renewal rates on the group business in FY24 vis-a-vis last 2 years?
Which is the question on renewal ratios or on the premium, sorry?
Premium renewal ratios. So the renewal ratios that we have shown in DRHP, how are those trending in FY24?
Our proposition is very strong, and it has only gotten stronger with the addition of the group portfolio. We maintain about 94.7% retention, higher than what we had presented earlier, in fact, almost by 50 bits. So I think that continues to be as strong as ever.
Sure. And secondly, there is talks of cashless everywhere. So how do you see your business changing with cashless being enabled at all hospitals in India?
Yeah, I think it's a great initiative for everybody's benefit from a policyholder perspective. So we are already over 60% by count in cashless in the inpatient, and almost 30+% by cashless in outpatient. And of course, historically, when policyholders went to a non-network hospital, there was simply no framework available for them to get help from the insurer because of the network requirement. Now, we're beginning to see those emergencies in those cases where policyholders are using the investments going to non-network hospitals, that we are actually able to support some of those cases. And of course, we continue to evaluate utilization of every hospital. And then as long as there is a hospital and then sees utilization, we continue to bring those hospitals into our network. That's why we've gotten to an 18,000 plus account on the network with a significant expansion in tier 2, 3, 4. So both will continue to happen, Nidesh, and cashless everywhere will continue to come to gaps where the network is not available.
But do you think the business model strength gets diluted with the cashless everywhere system, or because as a largest TPA, we are the largest hospital network, but the value of that will get diluted if cashless is available at all the hospitals, right?
That's not necessarily our view, Nidesh. I think so. One is the guarantee of service and the rates and the experience. That is why everybody invests in creating a network and creating that predictability. Cashless everywhere should be seen as an emergency access or a non-network access feature that is provided as an additional benefit. And so far what we have seen sort of supports of features.
Okay. Thank you, sir. That is from my side.
Thank you. The next question is from the line of Varun Gajaria from Boring AMC. Please go ahead.
Hi, sir. Thank you for the opportunity.
So from how I understand, a lot of your business is also based on tech, and you necessarily would have a platform for the same. So, what is the percentage of income that you are spending on tech every year, and how do you expect that trending forward? Since we are already at the cusp of integrating another acquisition.
Are you asking, Varun, how you're using tech towards integration of acquisitions and trend of the platform?
I just want to understand what is the expenditure that we are doing on those platforms, and how do we see that going forward? Essentially, you will have a team where you have someone to take care of this. So just want to understand what is the expenditure that we are doing there on running the platform.
So the tech is the main scale of how we actually deliver our services and retain customers. And one of the biggest reasons why our direct employee costs continue to be one of the lowest as a percentage of revenue in the entire industry. So really, we invest heavily in technology. We have in-house capabilities on building platforms, building products, and in data science. And that's an area we continue to invest in. And we build platforms not just for us, but there are industry partners who directly use our platforms for their internal use as well. I think that continues to be a focus area for us.
So how much have we invested so far in the platform, in building the platform?
Well, it's really hard to follow the question.
How much have we invested so far in setting up the platform?
We spend on an average about 3 to 4% of our revenues every year on the tech side of it. Yeah.
The total investment in the platform and categorization as of 31st of March last year was 10 crores. In the current year, we have been investing into a platform for the UK APs, which is around 3 crores we invested. The total cost will be around 9 crores. That is for the completely different business, which is the international rate benefits. Thank you.
Okay. And there are these contract liabilities on balance sheet. Could you walk us through what are those exactly? What is the nature of those contract liabilities?
Contract liabilities are same as the deferred revenue, unearned income that we spoke on the call, which is for the period for which we don't book revenues. Those are deferred to the next period. So as on March, we have 220 crores of revenue that have moved to the following year, which is FY2025.
Okay, of which 117 crores will be over the next few months, right?
The 117 crores relates to unbilled income.
That is already booked as revenues and is sitting as receivables, where the contract liabilities are not booked as revenues yet.
Okay. All right.
First of all, contract liability defined by the fact that when we do a 1/365 accounting, revenues from FY24 that are confirmed and received flowing into the revenue pool of FY25. The unbilled relates to a separate matter, which is 117 crores, and relates to, as our CFO explained, the delay between the start of a delivery contract that we have as a TPA and the date we bill the insurer for the fee that is due to us. I hope that has explained the difference between unbilled revenues and contract liabilities.
All right. Okay. Thank you.
Sorry to interrupt. Mr. Gajar, may we request that we have this question again, because with the interest in time, we will have to close this conference.
Yeah, no problem. We can take it up now. I'll reach out to you. Thank you.
Ladies and gentlemen.
Thanks to everybody for active participation. We are available offline to address any further queries you may have regarding our business and financials. We look forward to future interactions and staying connected. Please do write into us at investor.relations@mediassist.in to be added to our mailing list. Thank you.
Thank you, everybody. Thank you.
Thank you so much. On behalf of Medi Assist, that concludes this conference. Thank you for joining us. You may now disconnect your lines.